Hey everyone, this is Dan. Welcome to my October 30th market analysis. I know you're busy and have other things to do. That's why in less than 10 minutes, I will give you the most important information about the stock market as well as my forecast. I use a combination of technical analysis and fundamental analysis related to the macroeconomic events and political events. This is a list of the tools I use and the information I look at to do my work. First of all, let's look at what happened on Friday, October 30th. SPY was down 1.04%, QQQ was down 2.54%, Dow Jones was down 0.59%, and XLF was down 0.29%. It was pretty much bearish all around. Nancy Pelosi and Steve Mnuchin did not reach agreement on the stimulus package, but instead traded letters accusing each other of not trying hard enough. In the meanwhile, Mitch McConnell said another stimulus package would be possible if the GOP kept the Senate after the November 3rd election. I guess the flip side is that if the GOP does not keep the Senate, they will just do nothing and wait for the new senators to be sworn in January. That means we probably won't see a new stimulus package until February if the Democrats gain control of the Senate. Apple, Amazon, Google, and Facebook reported awesome earnings on Thursday, October 29th. The market was still down, however, on Friday in spite of the impressive earnings from Amazon, Google, and Facebook. That's not a good sign. COVID-19 daily new cases continue to go up in the US, UK, Germany, France, and other countries. We are seeing new lockdowns in UK, Germany, and France. It's COVID bad news all around again. Then we have the uncertainties related to the November 3rd election. Overall, I believe the outlook is bearish for at least next Monday and Tuesday. Let's look at SPY in more details. On Friday, it was down 1.04%. It was supported by the lower band of the Bollinger Bands, right here. RSI was at 37. That means it was not oversold yet. I see the downward channel here. Overall, the outlook is bearish for the next couple of trading days. The next support level will be at the September 24th low of 320. If that support is breached, the next support will be at the 200-day moving average of 313. Let's look at QQQ. On Friday, it was down 2.54%. It was supported by the lower band of the Bollinger Bands. Coincidentally, that's also where 100-day moving average is. That means it was a pretty strong support. If the market continue to go down, which is likely, as we can see from this downward trending channel, the next level of support will be at the September 21st level of 260. And if that level is breached, we might see some support at 250. And below that, the next support will be at a 200-day moving average of 242. Let's look at Treasury rates. Why are they important? Because they give us an indication of what the Federal Reserve Bank is doing or is not doing. There are three charts here showing the 5-year rate, 10-year rate, and 30-year rate for 2 days each, October 29th and October 30th. As we can see, the rates have gone up in the last couple of days. That means the Fed has not been buying treasuries much in the last couple of days. If the Fed had been buying treasuries, the rate would have come down instead of going up. Let's look at another chart related to the Fed. Now, this is the chart published by the St. Louis Fed every Thursday that shows the total Fed assets. As we can see, the Fed has been keeping the total assets at about the same level since June of this year. The last time the Fed significantly increased its assets was after March 11th. Back then, SPY had dropped 19% from its previous peak, and that's why the Fed had to buy assets and infuse money into the market to stabilize the stock market. As of last Friday, SPY is down only 9% from its recent peak. My guess is that the Fed will start buying assets aggressively if and when SPY goes down to about 300. We are currently at 326. We have a while to go yet. Let's look at a comparison between October and September. This is September, and this is October. They are almost identical to each other, except there are some real differences. Back in September, the market peaked on September 2nd due to overbought situations. The stimulus talks were still in progress. We were hopeful. The COVID curve came down. Here's September. We were waiting for the COVID vaccine to be ready. SPY hit bottom on September 24th, then started to recover. Today, the market peaked on October 12th at 1.5% below the September peak. That's a lower low, which is not a bullish sign. Again, let me repeat, it's not a bullish sign. It's a little bit bearish to have a lower low. The stimulus talk stopped, as we mentioned already. New COVID cases are up again. However, we're still hopeful for the COVID vaccines. Overall, I believe the situation today is more bearish now than back in September. Therefore, I expect the market to go below the September level in the next few days. Now, I don't want to take sides about the November election. We all know there are two possibilities. A, President Trump is re-elected, or B, Joe Biden is elected. If Trump is elected or re-elected, I expect the stimulus package to be passed and the market to recover quickly. If Biden wins, Washington, D.C. will most likely be in a lame duck mode, and we probably won't see a new stimulus package until next February. If that happens, we might see SPY go below 300 before it starts to recover. Now, you might ask the question, will we see a market crash similar to 2008? My prediction is that we won't, mainly because the Fed is now more accommodative today than back in 2008. This is my prediction of the worst case scenario in November. We are right here, SPY 326. If the market continues to go down and breaching the September low here, we will most likely see the Fibonacci retracement levels to be tested here, here, and there. But I believe the Fed will start to intervene when SPY is around 300. The market will then recover, and some people might say that the Fed is just kicking the can down the road and that a major crash is inevitable in the next couple of years. I will probably discuss that in another video in the next couple of weeks. For now, let's just get ready for a dip, but not a major crash in November. Let me repeat, I expect a dip, but not a major crash in November. This concludes my analysis. If you like what you see, please remember to click the subscribe button below and share the link of this video with your friends. I would appreciate your comments or questions. I included below the link to videos explaining some of the tools that I use, such as the Bollinger Bands, RSI, and Fibonacci Retracement. I'd appreciate you watching and wish you luck with your investments. Have a wonderful day.